Good morning, everyone, and welcome to my May market recap. We are certainly in interesting times in the real estate market, the economy and world events, and how those are affecting short and long-term views. Firstly, the local real estate market continues to be strong, but not as strong as it was even a couple of months ago. I believe sellers have adjusted their target price objectives to more align with buyers' expectations, but we are still in a seller's market. It is just not as strong as it was. Inventory remains restrictive moving into the summer selling season, with negative inventory levels in Montecito, Santa Barbara, Carpinteria, and Summerlin, with Hope Ranch being the only community showing positive inventory gains. What is of note is that the gap between the new listings and the sold and pending listings have diminished drastically in all areas within the last month. Is this a sign of a slowing market? Possibly, but more realistically, it is that the overheated market we have seen for the last year has started to realign and come closer to normal. Don't be surprised if houses start to trade at close to or below the list price moving forward, and expect to see more price adjustments on existing listings. As inflation starts to eat into buyers' purchasing power, stock market jitters continue and world events continue to weigh on consumer confidence. Moving forward, these events are expected to affect real estate valuations and trading volumes in the third and fourth quarter of 2022. Many of my regular readers are aware I have talked about the link between real estate prices and consumer confidence for years. In addition, identifying the lack of inventory as a market driver, inflation, which I forecasted 2 years ago, as having a major effect on the real estate, and last but not least, in the 3I categories, insurance premiums, although starting to show some signs of easing, are a major factor in the purchase of a new or replacement property in our local communities. As these three factors are now in play, I expect to see continued choppy waters ahead, with tight inventory levels remaining, although having less effect on increasing real estate price valuations. Inflation continues to remain at high levels despite projected and continued interest rate levels, and insurance premiums remaining flat or slightly decreasing in the year ahead. In the luxury market segment, I also expect to see some pullback in target pricing, as this will not be supported by the rising tide theory. All in all, I expect to see a trend towards normalcy in the marketplace, with prices starting to level out and in some instances retreat from what would have been considered their list price 2 to 3 months ago. However, a word of caution, this is June, typically a slower month in real estate, as many families are focused on graduations and summer vacations and not quite focused on moving homes. We will have to see if this traditional uptick we see in late July and August kick in prior to the start of the school year and revitalize the marketplace. But even so, I will hold true to my overall long-term view. As always, thank you for tuning in, and feel free to contact me with any real estate questions.